For the last 3 years, investors poured into a handful of tech giants while thousands of small cap stocks were left behind. That's actually starting to reverse, and it could be one of the biggest market rotations we've seen in years. So in this video, I'm going to explain why this is happening, why it may have further to run, and share 3 small cap stocks that could put you ahead of the crowd. And the last one isn't a stock most investors would even think to call a small cap, so make sure to stick around for that one. Hi, I'm Jacob Wade. I'm a financial coach for high income earners to help them retire early. And if you like timely financial news videos just like this one, hit the thumbs up button below. That just lets me know to keep making more videos just like this one. All right, so first, just let me give you some important context on what's going on here. The Russell 2000, the main index that tracks small cap stocks, just pushed to a record high after being stuck at the same range basically from 2021 to late 2024. And the performance gap this year is striking. Small caps ended up around 19% so far in 2026, and the S&P 500 is only up around 8%. So the small, overlooked corner of the market is actually running more than double the returns of the big famous index this year. Now let's talk about the real reason that this rotation actually has fuel. In a word, value. So take a look at what investors are actually paying for earnings across the entire market. The big S&P 500 names trade at around 20 times forward earnings. For the Meg 7, that number is a hair above 23, and for the small caps, it's only around 16 times. So in simple terms, you have to pay a premium for the large cap names, and you can get these smaller companies essentially at a discount. And what's interesting is that it's usually the other way around, actually. Normally, smaller companies cost more, not less, because they tend to grow faster. Now, that flipped a few years ago, and coming into this year, that gap has stretched to its widest in about 30 years, and now it's finally starting to snap back. And it's not just about being cheap. Analysts actually expect these smaller companies to grow their earnings faster than the big large caps going forward. So think about that combination for a second, right? Cheaper and growing quicker at the same time. That's the heart of the setup here. And there's a second piece to this too, and it's about interest rates, although probably not the way that you might think. Now, the Fed cut rates last year and has held steady since. Smaller companies carry a lot more floating rate debt than tech giants do. About a third of small cap debt actually moves with the rates versus under 10% for the big S&P 500 names. Suffice to say, small caps are just far more sensitive than the large cap counterparts. Now, they already felt some relief from last year's cuts, which is great, and if the Fed eventually eases again, it's the small caps that are going to actually benefit for the most from this. Now, the flip side is they are more exposed if rates stay higher for longer, so this is a sensitivity that can cut both ways. But here's the key. This isn't a buy any small cap fund moment. Roughly 40 to 46% of small cap companies are honestly still unprofitable. And those are the ones that struggle when money gets tight. The inflows are going to quality businesses with real earnings and strong balance sheets. Not every single small cap out there. So here's how I would play it. First, you need to check whether your portfolio is overloaded with the same mega cap names as everyone owns. It probably is. And second here, be selective. Cheap isn't enough. You actually want financially strong companies. And third, make sure you watch earnings revisions. If analysts keep raising estimates for small caps, this rotation likely has further to run. So that's exactly why when I built this list, I was using Zen Ratings. It grades stocks A through F using more than 115 factors. And I'll break down each pick, including where it falls short, so you're gonna get my honest review here. And by the way, finding those quality names is actually exactly what Steve Reitmeister, our editor-in-chief here at WallStreetZen, walks through in his free Monday training sessions at 7 p.m. Eastern. You can sign up for free at wallstreetzen.com/live, or you could just scan the QR code on the screen right here. Again, it's free, but you do have to sign up and register to join. All right, let's get to the stock picks here. Remember, I'm presenting real stocks and data, but I'm not telling you what to buy, so make sure you always do your own due diligence. All right, first up is going to be Motorcar Parts of America, ticker symbol MPAA. And as of the week I'm recording here, the stock is actually already up over 40% in the past month as investors rotate into overlooked industrial names. Now, the company makes essential aftermarket auto parts like alternators and brake components. And after years of uneven results, its latest earnings actually showed improved profitability and expanding margins. Now, let me show you the data underneath all that. Motorcar Parts comes in with an overall Zen rating of an A, which is a strong buy recommendation, and it ranks in the top 4% of all stocks tracked. By the way, these ratings are updated daily, so make sure if you want to get the most up-to-date information, go to WallStreetZen.com and just enter this or any other ticker symbol to get current data. Now, looking at the component grades that shape the overall rating of MPAA, it actually earns above average Bs for growth and for value. But the standout here is sentiment, which grades at an A, ranking it in the top 3% of all stocks. In plain terms, this just tells you that smart money, the analysts and the institutions, have started paying real attention to this name. But here's the honest part. 3 of the components here, momentum, safety, and financials, they all do come in at a C. This tracks, again, for a company with a turnaround in progress, where the early signs are genuinely encouraging and the smart money is leaning in, but the balance sheet still has some work to do. So here's how I would read this. It's a cheap domestic business that's just starting to recover, and smart money is already starting to notice that. So I just want to make sure that you're seeing both sides here, that it's an early stage turnaround, not a completely finished one. And just real quick, if you're getting value from this type of video, consider subscribing to the YouTube channel. We do this kind of grounded, data-driven research every single week, and I'd love to have you back for the next video. All right. Let's go into the next pick. All right, next up is Seneca Foods, ticker symbol SENEA. Now, if Motorcar Parts is an early stage turnaround, this one is the opposite. This is a steady, high quality value name. And you probably already know their products without knowing the company. Seneca Foods owns the Libby's brand, and they recently picked up the Green Giant frozen vegetable line in the United States. And here's why it's a compelling company right now, especially in a rotation toward quality value. Seneca trades at a trailing price to earnings ratio of about 10. Now, to put that in context, that's only about half the multiple of the broad large cap market. So you're getting a profitable, growing, established food company at a single digit earnings multiple. And on top of that, it's a low volatility stock with a beta of just 0.38, meaning it has historically moved far less than the overall market. And the balance sheet is healthy, which is great. It has a debt to equity ratio of just 0.65. This company honestly puts the quality in quality small caps. And the data backs this up. Seneca carries an overall Zen rating of an A strong buy recommendation. This overall fundamental score is in the top 1% of the entire market. In the component grades, we see that growth is in the top 17% of all of our stocks tracked. Sentiment is in the top 13%, value is in the top 12%, and the standout is financials, which clocks in at the top 8% of stocks tracked. Now, the honest weak spots here are momentum, safety, and the AI grade that comes in at a C. None of those readings are necessarily red flags, and all of them land slightly above average. So honestly, the bottom line on Seneca here is if Motorcar Parts is the higher risk, higher reward upside turnaround, Seneca is the sleep at night value name. Cheap, steady, profitable, and largely ignored. So in a rotation that's rewarding quality value, that's a strong combination. Again, if you like stock talk like this one, I want to once again remind you to check out WallStreetZen's no-cost live training sessions. You can join our editor-in-chief, Steve Reitmeister, on Mondays at 7 p.m. Eastern Time. And he doesn't just talk about what he's buying, but how he's finding the stock so you can actually do the same thing in the days ahead. And then he also shares his trade of the week, combining the Zen ratings with his 40-plus years of investing experience. So again, if you want more value from stock picks like this one, just pause the video real quick and go to wallstreetzen.com/live, or you can just find the link in the description below, or scan the QR code on the screen real quick, register, and we'll see you Monday at 7 p.m. Eastern. All right, the last pick here is honestly the most interesting on the list. It's V2X, ticker symbol VVX. Now, most investors don't think of defense as a small cap opportunity, but that's exactly what makes this pick compelling. Now, V2X provides logistics, maintenance, communications, and training that keep military operations running. Now, it doesn't build fighter jets, it keeps them flying. As governments increase their defense spending and prioritize domestic contractors, V2X is well positioned to benefit. And the growth shows it. Earnings growth has outpaced the industry by a huge margin. On top of that, the business has actually been beating earnings expectations consistently quarter after quarter for the better part of almost 2 years. So that combination, right, faster than peers growth plus a steady track record of delivering is exactly what you want to see. Now, here's the actual data. V2X earns an overall Zen rating of A strong buy recommendation. Overall fundamental score is in the top 3%, and it has strong safety and value grades as well. But the headline number here is the growth grade, which is an A, ranking in the top 1% of all stocks in our entire system. That is about as strong as a growth score can get. Now, just like the others, I'll give you the full picture here. A few components, momentum, sentiment, and financials, come in at a C. And the stock has pulled back a bit over the past month, but that's what also makes this somewhat interesting. You've got a business with an elite top 1% growth, a genuine national security tailwind, and reasonable valuation sitting in a name the broader market hasn't fully woken up to yet. So that gap right there between a top tier growth profile and the market's still a little bit hesitant on it, that's exactly the kind of setup that rewards getting in there early. So out of all these three names I mentioned, V2X honestly has the most distinct story and the strongest pure growth profile. And the market's still catching up, and for the right investor, that could be an opportunity. Well worth adding to your free watch list on WallStreetZen.com. So that's the current setup and the three names that fit inside of it. Money is rotating out of the expensive, crowded large cap trade and into the cheaper, faster growing small cap world. But because nearly half of small caps are financially fragile, this is a rotation that rewards quality over hype. And this kind of move doesn't come along often. The last time the market broke this hard away from a small group of dominant names, the years that followed looked very different from the years before it. Whether it plays out the same way this time, nobody actually knows for sure, but it's honestly worth paying attention to. Now, if you're not sure what to watch next, check out my recent video right here, reacting to Micron's recent price action. I actually broke down why it happens, why you can now buy the dip on the hottest memory stock, and whether or not you should. Again, it's on your screen right here. You can check it out.